All right, today was more like the kind of day that we would have expected that we did not get yesterday. But the nice thing about today is we did not build on yesterday's weakness and we rebounded a little bit of weakness after, as we saw a pretty significant jump in yields. After an initial drop, we saw a pretty significant jump throughout the day and put a lot of pressure on risk assets like the Qs and like IWM by the end of the day. So coming off their highs, the S&P especially coming off its highs by the end of the day, but still, not building on yesterday's weakness. And now we got Apple, Amazon, Microsoft, Meta, Google. We have all those earnings behind us. We still have Nvidia. We already had Tesla. We still have Nvidia coming up after options expiration in November. That's the one kind of outlier. But we've already had Intel, we've already had AMD, right? We've already had some other chip stocks come out. Intel was positive, AMD was negative. So all that's behind us. The jobs report's behind us. Now we've got the big week next week. So what do the charts look like going into next week? Is there anything we can expect going into next week? So I'm going to break that down because there are some. I mean, the market is not sideways, right? The market has produced signals to give us expectations of what to expect next week. Again, if we get something unexpected next week, and whatever that ends up being, then that can throw all that out the window. But there is a pretty clear direction of what we can expect next week based off of what the charts are showing us. So I'm going to break that down for you, what's driving this action, our trade idea in a sector that had a pretty decent year, but had a really bad week. So we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, November the 1st, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. And if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades, see whether we should get out of them or not. We also take a look at today's Market Outlook or today's trade. We put it on before the market closed. This is at 3:30 Eastern time. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It opens up this tab. Scroll down to today's Market Outlook. Click that like button there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day in and day out. Those who don't, you can do right now while you're watching to help us get our goal up to 100 likes on the Market Outlook tweet. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see the intermediate line continued lower today despite the small rally, but it was just a small rally. As you can see, became well off the highs. The intermediate line closed below the 60th percentile, so it's out of bullish territory, obviously still below market sentiment. The near-term line even got worse, right? It even ended up falling lower into the lower reversal zone. The momentum line jumped. It's hard for it to stay at extreme lows. Not impossible, as you can see over here. It stayed a couple of days in a row, but 1 or 2 days at the max, and that usually bounces back out even just a little bit like it did here, and that's what ended up happening. Again, we're going to get a near-term rally next week, right? The near-term line is going to jump. The question is, when it crosses above 40, is the momentum line higher? Ideally, is it above 80? And that would give us the higher possibility of a bullish near-term peak to develop. Because otherwise, if we end up with a bearish near-term peak coming off of a bearish low point, then now we are in intermediate decline. So that's something to kind of watch out for here next week. The Dow Jones, remember, does have dark pink shading and a red line already. So it's the second day that we are actually in intermediate decline. The intermediate line is in bearish territory. So we are in intermediate decline right now for the Dow. The short-term sentiment was improved. The momentum line and the near-term line both bounced. But they didn't bounce enough, right? So they're still down at lower levels. So there's that. If you take a look at the NASDAQ 100, which has been fueling both the rise and yesterday's weakness, its intermediate line has just barely crossed below market sentiment today. Still in bullish territory, but crossing below market sentiment today. And you can see its near-term line went from being above 60 to below 20 in 2 days, right? 1 day and then 2 days. and it's still down there. So pretty bearish short-term sentiment there. Again, a bull tag that wasn't necessarily too down. I mean, it's a little bit more than 1% bull tag there, and we haven't crossed back up above that high point yet, the high of that bull tag. And then finally, looking at the Russell 2000, also has dark pink shading and a red line. Its intermediate line is not in bearish territory yet like the Dow, but it is below its market sentiment. We did have a bearish near-term peak followed by this bearish near-term low point now, and so we are clearly in the early stages. And you know, again, it might just be, this might be all we get if things turn out favorably next week. But going into next week, you can see the markets with it, like I've said before, with all the information the market has to know about what could happen next week, this is what it's how it's preparing for the move, with a little bit of profit taking, I guess you could say, considering the bullish run that we've had. Let's take a look now at the weekly versions of these charts, since we're at the end of the week. And you can see, okay, we have a near-term line that has dropped from being above 60 to below. So this is period number 1 of the near-term line being below 60. I actually dropped below 40. The momentum line is below the near-term line, and it's below 20. So according to that, again, next week can be a complete wild card. Nobody knows. But going into next week, the market is, it's kind of like this move here. So you can see this was the first week that we were below 60 on the near-term line. We were a little bit lower. We were at 32, but the momentum line was oversold. And then the next week followed with some weakness there. It ended up being the down week, but that came after, right? So that's the kind of week we would expect to see next week, going into next week. Again, simply based off of this pattern. Whether that plays out, again, considering the wild cards, we don't know. But what the market does know is, you know, this is how they've set up the situation going into next week with everything that they do know, that they could possibly know about next week. Let's also take a look at the monthly chart, right? Because we ended the month last month, yesterday, excuse me, on the monthly chart. So here's our monthly look at the S&P. Again, the near-term line is still in bullish territory, so we don't have to worry about that. But that's a pretty extreme low 1 day into November. So we'll see how that turns out. If you take a look at just this move here, here we go. Well, here, let's just do it this way. We'll go October 31st, so we can not be influenced by, you know, today's move. And then we'll go to November 1st of 2004. And then we'll go to a monthly. There's a 20-year monthly chart going into yesterday. So this is what it looked like. Again, coming off the double cluster of August and September. Again, the only time the market's ever had a double cluster there. This is what it looked like. I mean, very small range. Look at that range. 204 points. Just for some perspective on that range here. Here again, we'll go to, what did I say, November 1st. For some perspective on that range, this is, here's the average, right? The average right now is at 30, and what do we say? We were at 20 on the range. So we already, the average itself is already pretty low. The ATR, yes, it looks high here, but again, on a normalized basis, it was already pretty low. Anything below 5% is really low. And we're close to it. This month was extremely low. So again, on a month that's typically pretty volatile, right? When you look at, you know, the seasonality charts for SPX, we tend to get some ups and downs in October. You can see we go into the month typically at a low point, and then we finish the month with a pretty good move towards a high. It's kind of similar to what we saw, a little similar to what we saw here, maybe off by a day or two. But there's typically a pretty decent range, and then you can see November and December ended up being pretty positive as well. So it's a little surprising that we had what is typically a pretty, what really has been the most volatile months seasonally that the markets has, and they've been really, really light. But that has not meant that volatility has been light. We'll see that here in just a second. Looking at some of the other oscillators, we did not finish below the 10-week moving average, so we avoided the red arrow that you see in all the other indexes. You can see we have the red arrow. Well, we don't have the red arrow. We did on the Dow. We ended up not finishing with it. The Russell also avoided finishing with the red arrow, and then the NASDAQ. So everything's getting that weekly, that transition candle that ended up being a pretty bearish transition candle. Again, setting us up for a bearish week next week. Not that we have to have one, because again, the unknowns, right, that can throw all this out the window. But based off of the knowns that there are, this is how the market's setting up going into next week with this bearish pattern. So it's setting up to have a bearish week next week there on that weekly chart. We also sometimes like to look at the weekly hull. So we'll take a look. The daily is turned south with the red line, the parabolic stars flipping. We're below the 200-day hull. But here's what the weekly looks like. So we are now below the 20-week. It hasn't turned red yet, but the parabolics are still clearly there. But you see how we've been converging. We had a little move above, but now we're already back below again. So we're going into a period where we would expect some weakness over the next week or two or three, which ultimately could produce an intermediate decline. Kind of a tip, whether it ends up being how strong the intermediate decline is, I think it would ultimately be a very typical one, similar to like this 5% move here or here, where probably not like this one. This was a very deep pullback bordering on correction, and this one also was a typical pullback, except for that one down day right there that went from a 5% drop down to a almost 9% drop because of that crazy August 5th level. That obviously 3 days later was completely reversed. So that should have been a typical pullback too, of around 5% plus or minus. I think that's ultimately what we would get here if we end up with another down week next week and or the week after that, and really nothing more than that as we head into it, like you saw, a seasonally bullish time of the year. We do not have three. Let's see. We do have three red arrows still on all the other, but we're close to not having them. So that's still 2 days now in a row, which is okay. 1, 2, maybe 3. Once you start getting past like that 3 days in a row, now you're in an intermediate decline, which especially when the line turns red, like you have for the diamonds and like you kind of have for the Russell 2000 there. And like I said, beginning stages of intermediate decline. Looking at the 2-line version, we haven't broken the 50 yet. That's kind of the key. Breaking the 50 now, we're because a pullback is a break of the 50 down towards a 200. In some cases you might fall short because of how far above the 200 you are. But for the most part, that's what a pullback is: breaking the 50, working down towards the 200. Correction would be breaking the 200 and working your way down towards the 200-week moving average. Obviously, we're not at that point, not even close to being at that point. Looking at the DMI, you'll notice still relatively bearish, above 25 on the negative, below 20 on the positive. Your ADX is still above 20, hence the light pink shading there. Looking at the RSI and the CCI, we did not get below 40, so through the end of this week, this stays green all the way through the end of this week. We did drop very, very low on the CCI. I brought that up yesterday, below minus 300, the lowest that we've seen in a very, very long time. We bounced back up, but we're still pretty low. Minus 178 is a pretty low number, which means the weekly chart is moving lower. Still nowhere near minus 100, so which means that this can also be pushed out to today as well. But something to keep an eye on, because how low the daily chart, I mean, that's a really, really low level, suggesting that there's some pretty bearish sentiment that's out there right now. If you take a look here at the Ichimoku cloud and the trend strength indicators, remember we ended a mature trend, which typically means the start of an intermediate decline. And so that's something to keep an eye on. We're still below the blue line. The rate of change, you can see, is now negative. So there's a difference there. We're still above the cloud, and the cloud is still green, hasn't crossed over, but you can see some signs of weakness there with the cross below the blue line, there with the negative rate of change, and here with the move to zero on those, coming off of a mature level, right? Finally, your Bollinger Bands and your Keltner channels, we remain even with the rally, we still remain in the lowest quartile of the bandwidth. The bandwidth is pretty low. the bandwidth is still inside, and our momentum has shifted from very weak positive to very weak negative. But again, we're a lot closer to flirting with a move to the downside than we are to the upside. Like on Monday, the red line is going to jump, right? Because this is going to come off, and then this will become the new low point. So the red line is going to jump up to, not the top, not the second, but the third, right? Which is right around 89. So it wouldn't be Monday or today. It would be the third day. So it's going to move up to 89, kind of similar to this. But the question will be whether or not it will be a temporary move up. If we get a new low on Monday, which, again, we're a lot closer to that than we are to new high. We did close below last week's low. We did not do that last week. We clearly closed below the low, and we had a lower high as well. So again, we are going into next week with bearish patterns. Again, the wild cards can throw all that out, and the gap, the runaway gap held for resistance. So there's and now has strengthened that resistance with the hold, right, with the touch and hold. So now it's even stronger. And so again, we're setting ourselves up for bearishness. You can see. So the diamonds did get that new low yesterday. So we have moved up to 100, and now the green line's moving lower. And the rate, the channel's very low, so the channel is set up for an expansion, right? A coiling to uncoil, so to speak. The volumes and the trading ranges have been very low. Yesterday was a little bit high. We ended up average volume today, a little bit below the average range. If you take a look at the volumes here with the money flow, we are in the lower half. We are not in bearish territory, but we are in the lower half, so the volumes are moving in the wrong direction. So we need to, if we're going to be bullish, we need to get right back up above here, kind of like what we saw here and what we saw over here, for an example, really over there too. We need to get right back up above, because breaking 50 is not a good sign from a money flow standpoint. We also didn't talk about this one. We were looking at the intraday range. Again, still in bearish territory below 40, and now we're falling. So we are clearly seeing bearish signs again going into a week that nobody knows what's going to end up happening. But again, based off what we do know, and where the VIX is still above 20. It's still at 100% relative to the VIX 3M. We still have a very high VVIX. We still have a relatively high skew. It's not as extreme as it has been. But it's because today is going to move up to 150, or it moved down to 152. But remember, 150 is extreme. The recent 5 years makes it look like 150 is not extreme, but the reality is, when you go back over time, 150 definitely is an extreme right here. And we've really had high levels here, and we've had high levels again now, to the point where these are the only two times where the actual average, 20-day averages, have gotten above 150. We saw what happened post, on the first peak, because we ended up with a correction. That's what this is telling us. The market is worried about the 2022 type move coming, and that's why the skew is so high and remains so high. And whether that will come out of next week or not remains to be seen. Obviously it would just be the early stages of that if it did next week. But again, the market is going into next week anticipating another week of weakness, and we would need something different than what the market has, the information the market has, right? We would need an unexpected outcome to change that. And it had to be an unexpected outcome in the positive direction. So whether or not that is like an absolute clear winner as of Wednesday morning, whether or not that's the Fed maybe walking back their rate cuts cycle, so maybe they say, not walking back their rate cut cycle, where the Fed says, we still are worried about unemployment, and so we're still going to maintain our projections. So they come out and say that we're still kind of expecting rate cuts. That wouldn't be good for 2025, but it would be good now for the rest of this calendar year. So that would be kind of the unexpected positive news that can derail the technicals that are suggesting weakness going into a new week next week. All right, now let's talk about what's driving this price action. So let's move here to look at just today, and then we'll look at the week that we just had. So again, coming into a very important week next week. This was a really important week this week. PCE, jobs reports, all across the week, and earnings, right? All the earnings that we've had, especially in the Mag 7. But next week probably probably expected to be a lot more pivotal in terms of which, producing market some volatility in either direction for the markets to start going one way or the other again after not really moving at all outside of one day this week. You can see bonds at the lowest. Bond yields finished really high today. We'll take a look at that in a second. But bond yields really were down today. Commodities were down today. So that inflation idea really low. The Qs benefited from, as well as IWM. They both were up. It's kind of matching the returns for the most part today. But the dollar was up. That's kind of interesting. The dollar and yields kind of move hand in hand, so they were both up. Kind of interesting to see that commodities did not go up. Gold, obviously pressured by the strong dollar, but generally commodities typically follow yields, and that wasn't the case today. And usually that helps areas like emerging markets do better, and they didn't. I mean, they ended up kind of break even on the day. If I go back to the week that we had, you can see bonds started down and then rallied. Yields fell in the middle of the day, middle of the week. That actually falling yields actually put pressure on equities here. This was the 2 days that we really had that decline, especially on Thursday. So we ended up down for the week on the Qs. We ended up flat on the week for IWM. IWM was doing so well early in the week that its decline basically brought it to flat levels. And of course the S&P was down 1.5. So a pretty strong week for small cap stocks relative to large cap stocks. That's probably not the relationship that we would like to see. Again, you would typically like to see small cap stocks underperforming large cap stocks. It is a relationship that is typically positively correlated with the S&P 500. You can see over the last 3 months that's been the case. Positive correlation, and you can see here coming off of its highs, not a very good week. Last week was a down week, and then not a very good week coming off the highs this week. So we're still up above some of these levels. I mean, that's the daily chart. Sorry, let's look at the weekly chart, and then you can see there the weekly chart again. Not a good week at all. It started off okay, but still, like I said, above moving averages. We're still way above that 200-week moving average. So we're still pretty strongly bullish, and that's a good sign. And this is positively correlated over 63 weeks. So it's a positive correlation that this generally has. Once we break that 50 and hold, right? So we broke that 50 in July, and then we bounced. If we break that 50 and hold and start to work into this gap and work down, that's typically when we're in correction mode. Of course, that means getting below the 200-day, which we actually already are below the 200-day. Let's see here. So I just go to a daily. Still slightly above it. It's the XLK versus SPY. That's the one that is still below its 200-day, which is, again, a very important relationship for the markets, as this is also positively correlated. It is below the 200-day, and we did rally today, but still finishing below the 50 after yesterday's breakdown. MACD getting lower, the histogram rolling over. On the long term, the PPO now down to minus 150, so clear bearish levels there. The RSI is in the lower half of the chart. The ADX is getting that slight crossover. So a little bit more of a bearish pattern now than what we had yesterday on these different oscillators, kind of confirming. The breadth move rebounded today slightly. We ended up finishing below 250 on the number of stocks above the 50-day moving average. Still kind of holding below that minus 350. The 350 is 70% level. Remember, the 325 is an important level. We get below that, and now we're kind of working our way down. Remember, 60% is this 300, 70% is 350. So right in the middle is 65%, and getting below that 65% mark is signs of weakness in terms of kind of longer term signs of weakness. The nice thing is we bounced up a little bit here, but we didn't bounce up very much on the number of new lows. Only 64 new highs, so that's not the greatest, and 62 lows. Remember, 72 is the magic number there, and so far we've been able to avoid getting to the number that would suggest a Hindenburg omen, right? As You can see here the breadth has not been great lately, and it's still below that minus 35 level. Again, getting below minus 35 typically means that you're in intermediate decline, as we've seen in all these other instances, especially when you've been below it this much. I mean, we are clearly below 500, which also, when you're above 1,000 and you drop below 500, it also typically means you're in intermediate decline. That's a pretty significant drop for us not to be yet, at least, in an intermediate decline. So some pretty clear moves away from the broadening trade that was so popular. It's been popularized. Obviously, we're moving away from that as you look at today, this week's move here in, go to the week that was, come out to like a 15-minute chart. And you can see XLK was our big loser on the week, and that is not what we want to see, right? We do not want to see XLK be the big loser. XLK needs to continue to outperform. That is the sector that is our market leader. It makes up a third of the market by itself, and it makes up as much of the market as all but two other sectors. In the consumer discretionary and communication services, all the other sectors, I think financials too, actually. But all but two or three of the other sectors make up the same amount, or a little bit less actually than XLK. Again, you can look at Brandon's tweet on that this to see. But that's not a good sign. Breaking below these averages is not good. We do not want to see this be a continual pattern, right? We would really love by the end of next week, post FOMC, post election result, that we can jump back. If we get below the 17-week moving average and we broke below the 8-week here, considering that we're already below the 50-week, that would be rough. That would be rough for this really important sector, this market leading sector, right? It's kind of below the 50-week, still below the 50-week after breaking below it this summer. We rebounded, but not enough. We're back below the 8 and 17-week moving averages. Working our way down towards the 200-week, which is correction mode, as you saw here, and we'd be in bear market if we get below that 200-week. So you can see we haven't been. Now it looks like the market's closed here. We haven't been below the 200-week since 2013. 2013 is the last time we were below that 200-week moving average, and that was when we had QE3, right? That really helped the broadening trade of that market, and then you see post QE3 we're able to really take off. But I mean, that's obviously not a good sign when that market, when this is not leading us higher up to the upside, considering it's generally more positively correlated with equities than not. So not good to see it be the biggest loser on the week. But on the other hand, utilities and real estate were also down there, and that is a good sign when those are the biggest losers on the week, because it typically means that non-cyclical trade is, the cyclical trade is favored over the non-cyclical trade. In this case, XLC was the big winner thanks to Google and Facebook this week. XLY doing pretty good too yesterday thanks to Amazon, outperforming, still down on the week but outperforming. And then financials and industrial materials also outperforming to a lesser degree. Also a good sign to see energy underperforming. Again, when that sector outperforms, that's not something we want to see either. But like I said, utilities being down. If I take a look at the utility sector here on this chart, utilities versus SPY, again on a long-term basis, it's been doing pretty well. It's still not up above that 200-week moving average yet, but it's been doing better. And you can see it's typically negatively correlated with the markets. So the more that this but it had a down week this week, and that's kind of where I want to go with our trade idea of the day. All right, let's take a look at our trade idea of the day, and it's actually in the utility sector as NEE and Xterra Energy. Had a good year from the bulk of the year. Kind of came into the year on a decline, intermediate decline, but had a really good year, going from around 50s, mid 50s up to the mid 80s, but appears to be kind of losing. It's like breaking through now the lower lows. You got dark pink shading and a red line. Your intermediate line well in the reversal zone. Market sentiment's falling. You're way down here below the moving average. So pretty bearish setup here. When you look at the weekly version, you're getting a weekly candle this week after a couple of transition candles, but last week's transition candle being a pretty bearish candle with the red arrow there. And so that's suggesting the reversal. You can see the PPO is falling still above the 90th percentile. So still very, very strongly strongly valued. Whether it's overvalued or not isn't the eye of the beholder, but still pretty strongly valued there. A good strong move up to the upside that we're coming down from, obviously, right now. Obviously, you have 3 red arrows. You've had 3 red arrows. You have a red line. There's what the line looks like there. You've had some pretty decent volume on this decline over the past few days. Pretty strong MACD momentum there. Stochastics well in the reversal zone. If you look at the 2-line version of this chart, we are trading in between the 50 and 200-day moving average. Pretty decent sized gap between those two, but we're moving down towards that 200-day moving average. The 8 and 17 have crossed below the 30, and they're moving down away from that. So pretty bearish levels. I mean, lower below the 50-day moving average than we ever got during this decline. If you look at the DMI and the ADX, you'll see some bearish patterns on these charts as well. Not quite above 30, but at least above 25, below 20 on the negative and a positive indicator. So your ADX is starting to rise again. You're looking at your RSI and your CCI. Remember, this is a utility company, so it's generally not that volatile, but it has been volatile enough. You're below 40 here, again lower than we got anytime during that pullback. And we were below 150, a little bit above 150 now, but we were below 150 on the CCI. Looking at the Ichimoku cloud and the trend strength indicators, we have an intermediate strength trend going on right now according to these two down here, and we are below the cloud. Again, we didn't get below the cloud during that pullback. The rate of change is clearly negative right now, so pretty significant bearish patterns. Finally, you get your last bearish patterns on the Bollinger Bands. You're flirting with that lower band, pushing down against that lower band here. And the bands themselves have closed outside of the Keltner channel. And we have closed outside. The stock itself, has closed below the lower Keltner channel. So you got the green dot. You got some increasingly bearish momentum as we move to the downside. So I decided on this one, again, because we're already about halfway between the 50 and 200-day moving averages, I decided here that we'd look at selling that 75 strike. Let's see here, it'd be, there we go, selling, sorry, here, let's go to the single symbol, and looks like I don't have it anymore. So I was selling the 75 strike, buying the 77.5, again, depending upon where we get filled in on that position sizing for that full $500 position, getting a little bit more than a 1-to-1 reward to risk ratio, with plenty of flexibility to work with, right? If you wanted to be a little bit more aggressive, you can go down to the low 30s. Let's do that one. Let's go down to the low 30s on this. Now that it's been changing since I've been looking at it, it's gotten a lot closer to 30s. It was kind of more in the mid 20s when I was first looking at this, but this is actually working just fine. So we'll position size this down here and get about a 2-to-1 with, again, a lot of flexibility for timing on this trade. As long as the max gain is inside the shaded window, then we're good to go, right? So we like that setup, and that will be our trade for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.